couple of more sessions to go, so let's start with this. So, you know, uh, if you heard all the sessions this morning, it's very, very clear that there's little fires everywhere. There's inflation, interest rates. Some have been even mentioning the R word, recession. So there's a lot of uncertainty to navigate. One of the biggest challenges as investors is how do we position our portfolios for all these uncertainties? And how do we actually maximize our opportunities? Are there strategies that we can learn from the past? And since we are in Singapore, is Singapore a great place to invest? At the same time, how do we invest for the long term, especially with the mega themes like sustainability, digitalization, emerging market consumption? So a lot of stuff to discuss, and I've got the right panel to do that. I've got on my left here, Robin Yeo. He's a CIO of Maybank Asset Management. He's got 20 years of investment experience. He started as a sell-side analyst, and his experience both managing traditional long-only and alternative funds. Prior to Maybank, Robin was in Pengana Capital, the hedge fund arm of National Australia Bank. And in the middle, we have Freddie Lim. He's the co-founder and CIO of Stashaway. Freddie was the managing director and global head of derivative strategy at Nomura, where he built and spearheaded an award-winning global team. He speaks regularly on quantitative finance, and he's also the creator of Stashaway's economic regime-based asset allocation model, which we'll talk about a little bit more. And then finally, we have Alvin Chow, CEO of Dr. Wealth. Which is a financial education company that aims to level up the financial literacy of individuals via courses, articles, and videos. He's been investing and writing publicly about financial markets since 2007, and he's trained over 5,000 individuals over the past 8 years. And he speaks widely on the media as well. So, gentlemen, let's start with the S&P is down 13% year to date. Nasdaq's down 24%. We've got inflation running at 40-year highs. Now, all of you have had many lifetimes in finance, right? So how do you compare this period in history with what you have experienced in the past? So let's start with you, Robin.
Thanks, Thilan. I think Thilan has wrapped it up nicely. I mean, it's an unprecedented situation. I mean, inflation is at multi-decade highs. We've seen recent drawdowns. But I guess from investors' point of view, I've been through many cycles. We take what is relevant from each cycle. This time it's unprecedented, but of course it was also unprecedented in the global financial crisis as well as the tech bubble. This time it's a combination of the tech bubble, right? Because all the growth stocks without earnings have dropped a lot, as well as probably the 2018 cycle, because at that time, the Fed Reserve also increased rates, and we saw a drawdown in the S&P. So I guess it's kind of a combination of those things. But as a market participant, we have to invest what we do, right? I guess in this scenario, we've had to be extremely nimble. At the start of the year, we were a little bit more positive on Asia, but we had to change tack, increase cash. It's only more recently we've become a little bit more bullish, especially on China. But I guess, the situations change. And as market participants, market investors, we have to adapt to the conditions, and the conditions have been tough. So I guess in the first quarter, we had to become a little bit more defensive. And as things change, things improve, we had to change and become a little bit more positive. I think that's what sums up the first quarter of 2022.
Sure. Freddie, what do you think?
Well, in a bit of a miniature of this 1970s style stagflation, this concern is out there. This elephant in this room, that we are not saying enough. We're not quite there yet, but there's a risk of that. So according to Economist survey, probability of recession just gone up from 10% to 30%. The direction is worrisome. But I think at the end of the day, unprecedented, as we always say, I'm actually looking at it as not as a market correction, but as a time correction. You have this feedback loop between central banks and the markets. I try to push you to price more. When you break, I'll take it back. This loop is going to be there for a while. Russia, Ukraine, they didn't win so easily. This is going on for a while. China's zero COVID policy, they have booth all over the country now. It's going to be sucked in. It's going to be there for a while. We have this time correction loop. So we've got to work harder as fund managers. Just that's the bad news. We've got to work a lot harder than before.
Right. And Alvin, what do you think?
I think the problem started probably about 13, 14 years ago, after the great financial crisis, where the Federal Reserve started to do a lot of quantitative easing. So we got easing 1, easing 2, until 4 during the COVID in 2020. And I think that because of all this easing along the way, there was a lot of liquidity that's flooding the market. And this money has to go somewhere. And stock market is one of the greatest places to park some of this liquidity. And that caused the US to have a very, very strong bull run in the last decade. And but unfortunately, those easy days were over because inflation now is creeping up, and Federal Reserve were forced to raise the rates, right, to rein in the liquidity, and they're going to start the quantitative tightening right now as we go along. So there will be a lot of all this, I think this liquidity change that we are not used to. We have not experienced this for the last 10 years. And I do agree with Freddie in the sense that investing is going to be more challenging, right? In the next, I wouldn't even say a few months, the next few years, probably, right? We'll see sector rotation. We'll see a lot of geopolitical tension as well. It's like everything is coming together into a nexus that makes investors face a lot more uncertainties than ever before.
Absolutely. So working hard, we're in unprecedented times. But one of the interesting things that all three of you touched upon was inflation, right? And we did hear that throughout the day today as well. So in your view, maybe I'll start with Robin. How sticky do you think the current inflation situation is? And do you think central banks are actually doing enough?
Right, I think on inflation, you have to break it down to two parts. One is the cost push inflation, which comes from food and energy, and that's a result of probably ESG, as well as, of course, the Ukraine war and demand pull, right? And demand pull is when there's just so many buyers pushing up prices and such. I would say that when you look at inflation on that perspective, the demand pull side is probably transient, right? Because, as we've seen, there's so much money put in the markets, as Alvin has mentioned, and that went up to asset prices, including property, right? And property is a huge component in US CPI, and that's pushed up the US CPI as well. So that is transient because, as we know, mortgage rates have gone up in the US, right? To a decade high, 5%. So that should lead to lower demand pull. And we also seen second-hand car prices go up in the US, right? Because of supply chain constraints. And as a result, people are going to buy new cars, buy second-hand cars, right? These demand pull side should turn down. Where there will be still some inflation is on the cost side, because all the climate change, ESG issues has meant an underinvestment in fossil fuel, and that should lead to higher energy prices in the long run. And also, of course, generally commodities, right? We've seen that remain high. So that's my take. But generally speaking, I would say inflation, my take is that it should have peaked, right? And maybe in this quarter or the next, it should come down gradually. But we are still seeing a higher inflation level than maybe in the years past. Yeah.
Right. So you think in the next quarter or so, inflation would peak. Freddie, what do you think? Do you think inflation's peaked or a little bit more to go?
I hate to disappoint by saying it's too early to tell.
Right.
It's not me to normally say that. I'll always give you a yes or no. But you do have a silver lining. We have the first decline in the PCE core deflator, which is a preferred target for the Fed, because it looks more into intermediate goods and services and the supply chain than the CPI. Now, so core inflation, so ex fresh food and energy is more the target. If I look at that, we had the first decline in the last month's data. If we get another 2 consecutive months of decline, you can start seeing calm in the bond markets for once. So that is the prerequisite, the minimum prerequisite in my view that we need. We're 1/3 the way there, so it's too early to tell.
Okay, so still a lot of uncertainty.
Don't remove your inflation hedges just yet.
Yeah. So that's a good question. That's something that I want to get to in a little while. I mean, one of the things that we've seen is, because of this inflation, and we haven't seen this since, I think, 2014 or so, is governments have become a lot more protectionist, right? I mean, you got China, Malaysia saying no more chickens for us, and the minister talked about that, and India and so on, palm oil. In your sort of past cycles, when you looked at it, have these protectionist measures really worked? And what do you think will happen? Maybe we start with Robin.
Actually, if you look in the past, it doesn't work. Protectionist measures generally doesn't work very well. And we've seen that, right? I mean, if you look at the sanctions against Russia, right? Although it does hurt Russia economically, it's cut off the supply of commodities to the rest of the world. And obviously, we've seen commodity prices in the oil side, wheat, soft commodities all go up. So this is a very clear sign that protectionist measures don't work, right? So we need to have a little bit more common sense, I would say, right, for countries to bring down tariffs if possible. I mean, tariffs usually are there, and bring it down temporarily, right? And that would help the inflation situation.
Right. Okay. Now, the reason, I mean, your day jobs are managing portfolios, and especially during times like this, I'm sure it's very, very challenging. So maybe I'll start with Alvin here. How are you approaching, your portfolios in the current environment? Are you keeping more cash, or are you still very much more invested?
Probably the context is that I'm more like a factor kind of investor. So I run different strategy. I just don't diversify mainly based on just asset classes, right? I also do diversification by strategy. So for me right now, definitely the commodities are the one that are running up due to the inflation situation. So, but we also understand that commodity prices, while it is nice on the bull run, it can change anytime because they are cyclical in nature. They don't go up forever. And that itself, I would be using the momentum strategy, right, to follow the trend a lot more, but to cut when the trend reverses. Then in terms of the more long-term investing, I will focus on more on the quality growth stocks. And we do see a lot of correction in the US as well as China as well. So when I talk about growth stocks, usually they are referring to this from these two countries because their longevity of growth is a lot more sustainable as compared to other countries like Singapore, which is smaller. So in those cases, I would just look for good value buys. If the valuation comes down to a good price, that's where I'll pick it up. And at this point in time, even though the market has come down quite a fair bit, I still find not a lot of attractive equities in terms of those kind of sustainable growth stocks. Currently, I'm sitting around 30% cash, waiting to be deployed.
Okay, 30% cash. Wow. Robin, what do you think?
Well, I mean, in a way, I do chime in, agree with Elvin. I mean, it's a kind of a difficult environment, and we are keeping more cash than before. I mean, usually we do unit trusts. So just to give you an example, most unit trusts are fully invested, but for us, we're keeping about 10% out in cash because we want to be a little bit more defensive and be able to take the opportunities when the market's correct. So what we've done is that at the start of the year, we were a little bit more bullish, but we had to change tack when the war came. So we had to raise a little bit more cash, but we are thinking now, things have stabilized, especially in China, and there seems to be a little bit more opportunity in China compared to the rest of the world. I think as Elvin has pointed out, some of these growth stocks have come down a lot, and where you see the growth stocks coming down with some fundamentals is actually in China. So we are tilting our portfolios a little bit towards more China and some of these Chinese internet names. So I think there is some more opportunity. I mean, it's not all gloom now because of the correction. We do see some opportunities now in the market.
Okay, that's interesting because I mean the narrative so far today has been very gloomy. So you're saying that through this gloom, there is opportunity. That's what we like to hear. So how would you look past this cycle? How would you when you think about the longer term investing? How would you think about the cycle beyond the next 12 months? Robin, and then I'll come to you, Freddie.
I guess the lesson to be learned across this cycle is having some bearing on fundamentals, right? Because in the past 1-2 years, there were many friends who say, "Hey, how come you didn't invest in crypto? Or why don't you buy this stock which has no earnings?" And traditional investors like ourselves, we were left behind, right? And all the stocks went up tremendously.
Sure.
A lot of them are back to square one, or maybe you're even losing some money. And what we've seen is obviously there's a reversion to fundamentals. So now everybody's looking at cash flows. You're looking at whether the company can turn around and be profitable. So I think that should be something in the long term you should look at in investing. And we've seen that cycle before, of course, in the last tech bubble, right, in 2000, right? There was pets.com and those sort of things, but people told me it would be different this time. Obviously, it was not. So I think people have to go back to looking at fundamentals. Of course, what we are seeing now is, as I mentioned, there are some stocks in China now which do display good fundamentals because they've corrected so much. Yeah.
Right. Okay, Freddie, what do you think? And I want to tag that, because what you do at Stashaway is quite unique with your economic regime-based asset allocation, where you optimize portfolios. So could you give us a little bit of a flavor of how you use that? And maybe for the audience, is there things that they can do in their own portfolio management that can, you can take away some from the ERAA?
Well, I created it so that it keep me under control. So because like any humans, we can have emotions. Maybe when you do things in and out every day, as human, we become less consistent. So the philosophy is the same, but it's rigidly applied or systematically applied when you have a framework. And the framework, what it does is it first look at the economic regime. At this point, it's inflationary growth, more so in the US. But the global economy, ex-US, is borderline trending between growing and not growing. So that's what that regime is saying. And when that's your starting point, and then you start asking yourself, what's your capital market assumptions, right? What's your reasonable expected return, volatility, correlations in such a regime? That's the starting point for the framework. And then it looks at valuations in two angles: valuation of a sector or the asset class versus factors. But it also looks at the valuation among themselves, the relatives. This is very important because if you have China stocks back in March 2021, and we had them as a long-term investors, you know that on a year-on-year basis, the outperformance was equivalent to 3 standard deviation long-term. Well, it's time to size down your allocations. You're not interfering with the algorithm, but the algorithm should say, well, I'm still going to invest in it, I'm going to do less, right? So that sort of shock management at the asset class level, done systematically. Unfortunately, putting all this framework together today, you end up with, you need to keep your inflation hedges, you need to invest in quality and momentum factors, which again will lead you to energy and materials. If you look hard enough, you start ending up with precision equipment makers, capital goods per makers, that this super diversified sort of names, if you look hard enough, or you get casualty insurers that is relatively undervalued. So if you work hard enough on your factors and your screening, you start seeing insights. So I think to answer the question, I hope that this is framework, and then it leads to some decisions that we can optimize for.
So take emotion out. Now, that actually brings me to, I mean, both of, Robin, Arvind, both of you are investing on a daily basis. You can have all these frameworks and things like that. How do you kind of get the emotion factor out? How do you kind of stay disciplined enough to not get swayed? Alvin, do you want to start?
I mean, at the end of the day, we are all humans, right? And we all know that there are law and order, there are rules, and somehow it is more convenient not to go by rules sometimes. And I do find myself at times override certain rules, even when it comes to investing. And but that happens like less than 10% of the time. And I think as long as majority of the time we follow a certain structure to save ourselves from committing certain grave mistakes, I think it has served its due. I don't think it is really possible to be 100% sticking by the rules. And sometimes rules do change because the environment do change. And we must have that flexibility to adapt as well. So that is my view.
Robin, how do you stay emotionless?
Well, I guess over the past few years, just like Freddie and Elvin, we've also invested in some sort of data science, right? So we have investment dashboards, which also look into various statistics, as I think as Elvin mentioned, we look at sector within the sector, how expensive it is versus the past, as well as relative. So those are the things we do. We also where we are, we also look at sentiment analysis, right? People are very bullish or bearish, and how we determine this is obviously we use a bit of clustering. When everybody's bearish, the correlation tends to be 1, right? And we use that to determine the bottoms of markets. So that, although it just gives a guide, right? It's not perfect. It just gives us a framework and it tries to help us when people either become too euphoric or too bearish. Yeah, so that's one way. I think Elvin actually pointed out quite well. In last year, where all the Chinese stocks were doing really well, it was what 2 standard deviations higher, 3, right? So that should have been a warning signal for people to kind of take profits as well. Yeah.
Right. Freddie, when I look around this room, there's quite a few young faces as well. And, we're talking a lot about inflation, right? And we've had no inflation since, say, the GFC, so on. So a lot of the young investors here, probably this is the first time in their career that they're experiencing inflation. So, how would you shield your portfolios with inflation? What are some of the key considerations people really should be looking at as they go forward?
First of all, I'm glad you relate me with the young people. Thanks a lot for that. Made my week. Now on to the question. I think young people, you are a very different group, right? You got more time than people like me or Dylan.
Still young.
I mean, relative is all relative, and we are planning for retirement, but you are growing, so you can afford to do dollar cost averaging. You can afford to. You should be first doing a rainy day fund, right? If it's 6 to 12 months, to feel safe. That depends on your job security. But once beyond that, you should invest systematically on a monthly basis, whatever you can save net. Regardless of what happens to the market, it doesn't matter. Given enough time, it doesn't matter. As long as you don't leverage, it doesn't matter. So I'm just trying to say you have staying power. You have time to recover from market corrections. We have less time than a relatively younger person. So, brave on. Don't worry. Invest. No problem. Whatever it is. I mean it.
Great. Right. Go forward without fear. All right. So let me just change topics a little bit and come to you, Alvin. You are known on the street as a hardcore value investor, right? And we've seen the devastation a lot of the growth stocks have had. Cathy Wood's ARK ETF is down 55% so far this year. So do you think growth is dead?
I was asked the same question about value a few years ago. I guess the theme just changes with the flow, right? But first thing is that even though many people view me as a value investor, I do have various styles. I do growth as well. So same answer to the value investing is dead a few years ago. I don't think growth investing is dead this time round. It is just a cycle, right? If you stretch through the decades, if you see value growth, they always cycle each other. They always have a bit of an anti-correlation. When value do well, growth tend not to do well, and vice versa. So I think it's just another phase of the cycle. Just that the last few years, growth investing has grown very, very sexy because of the exceptional returns that we have seen, especially in the US markets. And the more losses you have, the faster your stock price goes up. That was the experience. And that was because of a very low interest rate environment. that the discounting of future value is almost negligible to today. And that means that the potential return of all these high growth stocks is going to be much higher than the traditional, say, a value stock, which is growing slowly and is giving most of its earnings as dividends. So it's not as sexy and it's not as high growth as the loss-making ones. But now we are turning into another macro environment that is very different from the last 13 years, right? Now interest rate is going up, inflation is going up, and which means the discounting of all these growth stocks is going to be very heavy. And that's why they have been beaten down since November last year. And I don't think this situation is going to change anytime soon, and which means that growth investing may stay out of fashion for the next few years, while value is in vogue. But eventually, I think that they will take turn. Growth will come back up, value will go back down again. So everything is a cycle.
So you still need to keep some of those growth stocks in your radar.
Yeah.
And-
Which means if let's say the horizon, like just now we talk about young people, right? Their investing horizon probably like 20, 30 years. Definitely you're going to hold that position, the growth stock position longer than the cycle. So I don't think it is a problem. Yeah, like Freddie said, keep investing.
Right. Freddie, anything you want to add to that?
If I take the risk further and start looking at disruptive technologies, innovations, you got to know that when you're on the left, to me, maybe to your left, the left-hand side of the adoption curve, very, very early days, just innovation hasn't been adopted, it's very early. The price volatility is going to be very high. And whenever the punch bowl is being pulled by the central bank, it's going to magnify those market volatilities. So don't make those mark-to-market real. From day one, when you invest, you're going to say, well, let's be real. This guy is going to be volatile until it's mainstream. It could be 10 or 20 or 30 years or never. I'm going to dedicate 5% of my total portfolio to such disruptive technology investments. So be it. It's always going to be 5%, and I'm not going to care. But it's not going to be 100% of my portfolios. Right sizing it is so critical. So that go back to financial planning, back to basics.
All right. Have a plan. Okay. Now, we are in Singapore, and we have seen something that we haven't seen in a long time when investing in the Singapore market, which is it's actually outperforming. It's up 3% year to date, the STI. Now, Robin, why do you think that's the case?
Thilan, actually, it's due to what actually Alvin has mentioned, right? I mean, it's a switch to value. And Singapore, actually, if you look at it, it's a value market. There are banks, there are utility companies, some energy companies, and REITs, which are very, very old economy stuff. And when the growth stocks were out of favor, people went back into value stocks. And that is I would say, the sweet spot for investing, right? And you can see not just Singapore, you look at entire ASEAN, full of banks, energy companies, telcos, and this has benefited in this environment is the switch from growth to value, and that has propelled the Singapore market, I guess.
All right. Alvin, anything you want to add to that?
No, I think Robin nailed it.
Yeah. But one of the things that I was very curious about is that when you look at the Singapore market from an institutional investor point of view, they've actually been net selling the market for the past sort of 12 months. Net sales around 873 million Sing dollars. So why do you think, yes, we have this shift into value, but why do you think some of the smart money is leaving Singapore? And where do you think some of that is going?
Actually, it's hard to understand why there has been outflows from Singapore. The only thing I could think of is, generally speaking, there's been outflow from Asia. And because Singapore was part of Asia, they've just withdrawn their monies. Global investors have been, from probably last year, they've been plowing into the developed markets. And, because of the fears of China and such, a lot of monies have flown out from there. And I guess because Singapore is part of Asia, these monies have just flown out to Singapore as well.
Right, right. So that kind of brings me to the big panda in the room, China, right? I mean, China's down 13% year to date. And, there are a lot of observers who are saying, given all the, zero COVID policies, the common prosperity policy, it's almost uninvestable. What are your views here? And can China really be ignored? Maybe we start with you, Freddie.
Quick answer is you can't ignore China, but you don't necessarily have to be directly in China at this point. Number one radar on my risk dashboard, sanctions risk. Just looking at Russia, for example, right? If you have an ETF that has 0.01% of a Russian name, that ETF, you have issues. You can't buy any more of that. You want to try to sell, but you can't. So your assets will be frozen just because of that. So I'm more concerned about expressing the China investment idea appropriately in an environment where you can have the US dangling sanctions here and there all the time, China threatening back. All these issues is not going to go away. So, and it's got nothing to do with whether prices are going up or down. So if you really want to invest in China direct, you're better off in Hong Kong, not in the US through ADRs. That's really going to be in the crossfire. Maybe even Singapore should pick up the slack where, yeah, hints. That would be my advice. But China has implications for supply chains with its policies. It affects inflation, so we watch it. China also have implications for Australian markets, Canadian markets. These are good markets to find good ideas where they can double head as a quality play and double head as inflation hedged commodity exporting countries. So if you work hard enough, you watch China enough, you can still find ways to express that exposure in a safer manner. So I prefer to just not be in a direct line of fire right now, but I'm watching it very closely.
Right. So I think the sanction risk that you brought in is actually a very interesting sort of geopolitical angle that we haven't explored or unpacked too much. Robin, what do you think about China?
Yeah, I mean, based on what Freddie says, yes, sanction risk is an issue. But generally speaking, if you're not from the US, and you're an investor in this part of the world, the risk is much lower because your home country is not going to sanction China, right? So that's less of an issue. And what we are seeing in China is actually there are a lot of values to be found, of course. If you look at the past 2 years, the drawdown in Chinese markets has been 50%, right? Some of the internet names are down 60, 70% from the peak. And that's why we think that's an opportunity. Although, some people have said now it's uninvestable. If you look in the longer run, China is likely to continue growing. You can't stop it. And they also know that capitalism, they still need, or well, maybe not capitalism, but they need a market-driven system to improve their economy. And the market-driven system also means that you get to get involved in the stock market, right? So I guess in the long run, as the country gets bigger, as their companies get bigger, you can't ignore it, right? As Freddie has mentioned, you really can't ignore. So even in Asia, despite everything, China is still 40 to 50% of the indices in Asia. So you really can't ignore. Is this whether you think China is going to continue growing, or with all the pressure from the US, then the Chinese economy will stagnate in the long run? So our thinking is no. There are 1.4 billion people. They are learning a lot of technology, and we think that they want to progress, and they have the means even within China to progress. And I think our longer bet is China should continue growing.
Right. Okay. Alvin, are there any sectors in China that you would be very excited about at this stage when you're looking at valuations? And
I do. I think China potential goes beyond just the tech companies that a lot of people know. A lot of people just look at China, Alibaba or Tencent, right? That's the very common names. But I think that there are a lot more potential in other stocks as well, especially the consumer brands, which include both staples and discretionary. The reason why I say so is because of it's a huge domestic market to begin with. If we don't take the whole 1.4 billion people, we just take the coastal area, which they are the more well-off ones, we are still looking at 600 million people. And that's double that of the US, 300 million people. And their affluence have gone up, and which means the consumption, domestic consumption is going to go up. And after exporting to the rest of the world for the last 30, 40 years, now China is ready to spur their domestic consumption, where that's why they coined the term dual circulation economy. Right? They start to look more inward, and that will push the consumer brands to a different level. That's the way I see it, and I think that just like how Buffett wrote the growth in consumer brands in the 1780s, 90s, right, in the US, I think we have that Buffett-like moment in China consumer brands at this point in time.
Right. I want to leave, there's a lot of questions coming in, so I do want to leave some time for that. But, I think, we've talked a lot about equities, so I just want to kind of go into a couple of the other asset classes. Freddie, what about fixed income? I mean, we've seen the bond markets have rallied over the past few weeks, 10 years below 3% again. So is this time to revisit this asset class? And we've also got a tag-on question from the audience in terms of sovereign debt risk. Is that something that we should be worried about a lot more now?
I think related to the answer to inflation, the bond market stabilizes when you see at least 3 consecutive months of decline in the PCE core deflator. I think that requirement for me is a minimum. We are not there yet. We have 1 month. So in 2 months, I'll tell you again. But generally, the long end of the bond markets will be very different from the other segments because of continuous demand from long-term people with long-term liabilities. They will still always need to manage their assets versus liability durations. So the long end turns out to be the better place to be. But if you look at anything outside the bond market, there are better places to park your money. So why be in bond markets right now?
Fair enough. Now, another asset class that we have to talk about is crypto. Recently, Christine Lagarde from IMF said it's worth nothing. Is that true? I mean, do you think it's worth zero, Alvin? I'll start with you because you're the value guy, but then I'll get to you, Freddie, because you're the young guy.
You challenge the value guy.
Disclosure is that I do have some crypto, and I do think that it's an allocation thing, right? You are not going to put like a lot. Although I know that there are some young people who put 100% into crypto, I think that's definitely too risky. And just with any kind of disruptive technology, crypto is part of it, right? I do think that there could be a future, but you never know. And anything that is very young has a lot of problems, teething problems, which we already start to see some of them unraveling, right? Like Luna just went bust. So I do think they're managing the risk, but at the same time, participating in a possible future is something that, as investors, is a prudent way to do it. I will put it that way. And of course, a lot of the central banks or even government around the world, they will not want to lose control of their currency. It's one of the key proposition why a government exists, right? To be able to have the power to control or manipulate the economy in a certain way. So I don't think any central bank would be sane to give up that control. And that's why they want to come up with all the central bank digital currency. And somehow I think that there will eventually be a 2-track. One is the really decentralized version that is bottom up. Then the other one will be the centralized version that the central banks issue. I think this coexistence will happen in the next few decades.
Right. Freddie, what do you think?
Well, to Christine Lagarde's point, it says it's worth nothing. I would rather say instead it's backed by nothing. But doesn't mean it's worth nothing. Because the ecosystem is being built. Yes, it's early, but it's being built, and the network effect itself is worth something. It's like in a network of this room of people, if we all tax each other, but each tax has a certain processing fee, there's a certain economic value when the network becomes active and interact among ourselves. So that kind of valuation is very different from traditional metrics of looking at cash flows and earnings. This one is based on utility. And hence, if you look at that, I would urge anyone interested to look at McAfee law on the internet. It's in the Journal of Computer Science, years before crypto was founded. There's a way to value these things. Facebook itself is like a marketplace. Amazon is like a marketplace. If you look at them as network, actually there are better ways to value companies with networks than to use EPS or PE ratios. So check that out. Crypto is expensive. A lot of them are trading at multiples to the McAfee law implied fair value. So instead of PER, price earnings ratio, we're talking about PMRL, right? So have a look at that, find your places, pick your battles in the right places, and be in the long haul. They are not going to go away. They're under the winter now for the third or fourth time. Maybe now is not a bad idea.
Right. So it was interesting as you said, pick the right battles in the right places, right? So here's a question. There's a question from the audience here. I mean, one of the places we cannot ignore with this whole crypto technology is the metaverse. And how should we factor this in investments? Anyone want to take a crack at that?
Tough
Freddie.
questions. Very difficult
Freddie.
question.
Okay, when we talk about metaverse, we think about Thielen in goggles and looking at someone and then like something and just buy it. But how does it happen? Does it happen on Facebook's network? Not sure. I don't trust Facebook. Governments don't trust Facebook. So Libra is not going to happen. So who is actually going to win and be the real metaverse? We're all competing to all the metaverses, sub-metaverses are competing among ourselves. So metaverse is an idea, very futuristic, maybe 20 years too early or 10 years too early. So right now it's going to be a mess. You're going to have a lot of names wrongly being labeled as a metaverse play.
Right.
You're right. Facebook could be one of them, but I beg to differ. So I think it's very difficult. You got to get your hands dirty. You got to be in the crypto network. You got to be in DeFi protocols. You got to physically actually invest and stake your tokens into a project and not expect to liquidate it for a very long time. So it's not for the faint-hearted. It's going to be very long-term. Money you don't need, that's what you do in metaverse as well.
Right. So
Just wanted to add what Freddie said. I mean, on the metaverse, I'm not smart enough to do all that valuation of Macaulay and all that stuff. But my thinking is, if you want to invest in metaverse, I think maybe a better way of doing it is invest in the equipment providers to the metaverse, right? The guys who provide the servers, the processors, because everybody will be investing in that, right? And that should be good for the companies providing your chips, for your servers, for all the metaverse, which requires a lot of processing power. And I think there are some opportunities out there, some stocks out there which actually do this sort of thing. Yeah, so maybe investors should look at that. I think a good example in the past, people have said, in the gold rush of California, the guys who made money was Levi's jeans, because all the gold prospectors bought jeans. And that's how Levi's made money, right? Whereas all the gold prospectors, they didn't really make much money at all because they didn't find much gold.
right.
So we're not saying buy cryptocurrencies. We're saying
Buy providers,
or invest in the blockchain project, but be very, very clear.
Yes.
Be very due on this.
Right. Robin, this is a question for you. I mean, passive investments was very popular, but now with the shift in the macro conditions, the sell-offs have been very sharp. Do we need to move more towards active investment strategies?
I think it is a phase, it's a cycle as well. I mean, the passive investing was a rage for the past 5 years, but of course things got extreme because passive investing was just buying based on market cap and not on valuation. And we've seen as a result of that, valuations of various market indices and ETFs go to extreme levels. So it helps active investors like us now because we've started to outperform all the passive investment vehicles. But there will be a stage, of course, where it makes sense to be in passive because, to be fair, passive also is much cheaper than active investing. So there's a room for both. But I would say in the past 2-3 years, this passive has just gone to be such a big part of the market that they've pushed valuations just way beyond extremes here.
Right. Okay. I'm aware of the time. So one of the questions here is, what market or country are you most bullish on in ASEAN? So maybe we go through each one of you and then we'll go to the next segment. So maybe Alvin, you want to start? Where are you most bullish on in ASEAN?
Of course, it's my beloved Singapore. So
Oh.
I believe so. That's where we are. I think because the government has proven to navigate a lot of crises in the past, and emerges quite unscathed as compared to a lot of other countries in the region. So definitely my bet is still going to be on Singapore.
Okay, Singapore.
He just took my bet.
You took your bet. Okay.
I was going to say Singapore REITs in particular, but I think the reopening story, the pragmatic policies, the evolution of the virus to something so tame. What BA1, Omicron, BA2 merging to become XE, they're getting easier and easier to transmit, but they're getting weaker. So to a reopening story, Singapore is at the forefront of it. Straits Times Index outperforming, not surprised. I'll go even deep down to the REITs to find gems there, high yield with potential for capital gains. Singapore, yes.
Okay, so 2 out of 3 Singapore. Robin.
No peer pressure.
Under pressure now, you know. Well, I think my choice is not Singapore.
Okay.
It'll be Indonesia, right? I mean, why Indonesia? Actually, for many years, Indonesia has been hitting below its weight. You know, there's 270 million people in Indonesia, right? And the amount of FDI it receives, it's about as much as Singapore, which has only 5 million people. So what has happened over the past 2-3 years, I've been quite encouraged. So they have a new cabinet with, Jokowi has done a good job. He's appointed a cabinet of technocrats, right? And they're drawing a lot of FDI in. One thing good about Indonesia, they have the commodities for the EV cycle. So they have nickel, right? They have bits of lithium. You know, they have a lot of elements which go into the EV space. And as a result, even Hyundai is setting up its EV center in Indonesia, not Thailand, where supposed to be the Detroit of Asia and all that, but not Thailand, not Malaysia, Singapore, of course not, because it's too small. So Indonesia. So we've been seeing that over the past 2-3 years, and to be fair, I mean, the FDI has gone up quite a bit, right? So I think that will continue. And if you look at the ministers, I mean, they appointed the founder of Gojek to be part of the cabinet in Indonesia, which is a change, right? In the past, there was a general in charge in Indonesia, but it seems like they have a technocratic cabinet, and from a low base, I think they should progress quite well over the next 5 to 10 years. Indonesia, yeah.
All right. So Indonesia underinvested, Singapore stability and ability of the government to navigate. That's interesting. Now we only have a few seconds left, but while audience, this is not investment advice. I'm going to ask each of the panelists to talk about 2 stocks that they like. Right. So these are just stocks that they like. So Alvin, do you want to start and tell us 2 stocks that you think at this sort of juncture that you really like?
These are not stock tips, and
These are not stock tips.
For disclosure, I own them. So the first, I would think that I'm a long-term China bull, and I do think that the recent correction, not say recent, for the past 1.5 years correction in China has presented very good opportunity for Chinese growth stocks. And I mentioned about I like the consumer brands. So the first one that I'll talk about would be Media. It's the #1 home appliance company in China. You might have even seen their advertisement going around on buses, on taxi. They've been very aggressive. You can even see their brands in our supermarket NTUC. So I think China is trying to venture out. Their companies are trying to venture out, and we start to see that kind of sparks of MNCs being created. And I think that will create the longevity of growth that we are looking at. So that's the first one. The second one is a bit morbid. It's a funeral company. We all will pass away one day. So I think we all need the services eventually. But it's very limited to China. It's called Fu Shouyuan. It's listed in Hong Kong. And it's a more premium tier kind of private funeral. You can buy a plot of land and where you can bury your next of kin in there, and you can visit. So they even have a cloud-based service where you can have those kind of rituals. So it's quite interesting, I would say. These are my 2 picks.
Great. Freddie, very quickly.
Quick disclaimer, ETF investors, portfolio builder, not single selection guy, but I ran some screening this morning based on inflation theme, based on valuation, based on debt to asset ratio, because interest rates is up. I want to make sure you have longevity there. So putting all together, I got 2 names that's very interesting. First, Carlyle, which is a plant and equipment capital goods maker. and distributors. So they will service aircraft manufacturing, they will service roofing, trucking, real estate sectors, construction sectors, the servicer all the way deep into the economy. I think that's a differentiated way. Its valuation versus peers, not expensive on a forward-looking basis, trailing PE, trailing ROE versus forward, not much difference. So that's where you have opportunities. It's not priced in yet. Then number two, a casualty insurance agent. Is core WR Berkeley Corporations. So this is one of those things I'm looking at servicer, people who are selling differentiated product, not pro-cyclical, but sort of it's always there, it's always necessary. So casualty insurance, the duration of it, the liabilities are not long, it's manageable by, so the risk on the U curve is low. So overall valuation, spot versus forward, pretty tight, not very priced in. There's upside in it. So two names, but very systematic. And I'm not a single stock investor.
Brilliant. Okay. Robin.
It's interesting that Alvin and Freddie, who are very, very bullish, Singapore did not have any stocks, whereas I chose Indonesia, but my picks are Singapore stocks. How that works, I don't know. But anyway, my two picks in Singapore are Capital Land Investment, right? And Capital Land, what I like about it is they've changed their business model. They used to be a developer. Now they're more of a platform company, right? So Capital Land, the revenue is coming from all their REITs and all their funds. So they're actually getting a lot of fees income from all their assets, right? And what that means is it's pretty steady, right? Generates a lot of cash flow, little capex. Number two, even if there's inflation, it doesn't really affect them much because the inflation problems are handled at the REIT level, right? Not them. So whatever it is, whether it's rain or shine, they should be able to get that income from their assets. So that's one pick. The other pick in Singapore I like is ST Engineering, right? So ST Engineering does commercial MRO, maintenance, repair, aircraft. And what they do is they have two sides of it. One, they do the Singapore Air Force, and they do a lot of defense contracts. The other part is, of course, they do commercial airlines. So what I like about it is if things are really bad, well, they have a lot of government contracts which will bite them for the next few years, contracts at the highest ever. Well, if commercial airlines traveling comes back, they get that benefit from the commercial airlines. So I think SC Engineering, it's a pick for me. One bad thing about it, it's not an ESG stock, right? They make armaments, they make bombs and that sort of thing. So, you wouldn't invest it if you're an ESG investor.
Right. Thank you. I mean, I think that's a lot of food for thought. Unfortunately, we've completely run out of time. So I want to say thank you so much, gentlemen. Robin, Freddie, Alvin, thank you so much for joining us today and giving us your time. And thank you, audience, as well.
Thank you.